Before we begin, do not forget to hit subscribe for daily investing insights. The global markets just responded with a surge to one thing: talks between the United States and China that may change everything. In this video, you will learn what really happened behind closed doors in Geneva, why this matters more than inflation or interest rates, what sectors could benefit most in the coming days. 1. A surprising shift in tone after 2 intense days of negotiations in Geneva. The United States announced substantial progress in its trade discussions with China. Treasury Secretary Scott Bessent stated the meetings were productive, hinting at meaningful compromises without revealing details. Both sides avoided aggressive rhetoric. Even the U.S. trade representative suggested that the gap between the two nations was smaller than expected. While the Chinese remained discreet, official state media described the event as a key step forward. This suggests a realignment may be happening, one that markets have been desperate for. 2. Trump changes the game. Again, in typical fashion, former President Trump posted an update on Truth Social describing the meeting as a reset, a fresh start. His exact words: "Major progress has been made. It took just one message to change investor sentiment, and the market's reaction was immediate." 3. Why markets reacted so strongly? What does this tell us? Not much on the surface. But look deeper, and one thing is clear: traditional macroeconomic indicators are not moving the market anymore. The only factor that triggered a shift was trade uncertainty, especially between the US, China, and the European Union. China is the top goods supplier to the US, and the EU is its second largest customer for American exports, particularly in natural resources. Without solid trade agreements, systemic vulnerability remains high, especially for multinational corporations. 4. What happens next? With the China deal progressing and a UK trade agreement already in place, the next big announcement may be with the European Union. Analysts suggest this could happen in the coming weeks. Meanwhile, market indices are showing signs of stability. The S&P 500 and Nasdaq are moving above their 200-day moving averages, with SPY and QQQ leading the rally. The Russell 2000 is still lagging, indicating an uneven recovery, but that might change if momentum holds through month-end. 5. Portfolios are moving faster than the market. While the S&P 500 gained 4.7% over the last month, some diversified portfolios, particularly those exposed to AI, robotics, energy, cloud, e-commerce, fintech, and semiconductors, have seen gains over 14%. This suggests that sector rotation is already underway. If trade deals are finalized, these areas could explode higher. 6. What to watch this week? It is a packed week for economic data. Keep your eyes on CPI and PPI reports, Fed balance sheet changes, University of Michigan Sentiment Index building permits data, remarks from Federal Reserve Chairman Jerome Powell. These events will shape market volatility in the short term. 7. Bonus. Geopolitical flashpoint. India and Pakistan. Trump also announced plans to boost trade with both India and Pakistan after they agreed to a fragile ceasefire. While symbolic, this move has deeper implications. Recent fighting exposed critical flaws in Chinese military technology used by Pakistan, highlighting poor drone performance, failed anti-missile systems, and unreliable fighter jets. It is clear that India's strength is forcing a shift in strategic alliances. The US sees India as a stable manufacturing partner, and China's attempts to create chaos have backfired. Final thoughts: markets may open in the green this week. The old Wall Street saying, "Sell in May and go away," may be dead. A new phrase is emerging: buy strategically, stay invested, and ride the recovery. This is not just market noise, it is the early signal of a possible economic rebound. If you found this helpful, do not forget to hit subscribe for daily investing tips.